earnings season. So let's get in. Supriya Lifesciences saw a sequential recovery in their margins in the fourth quarter as the traction in their regulated markets improved. We have with us Saloni Wagh, who's the whole-time director at the company, joining in to tell us more about the quarter gone by. Thanks a lot, Saloni, for joining in. And that really is the first question. I mean, what proportion of your current revenue now comes in from regulated markets? You've been eyeing a higher share coming in from that. So what's the target for FY24 specifically from the regulated markets?
So currently about 45% of the total sales is coming from the regulated markets, and you can see that in the Q4 results as well. The target is going forward, at least about 55 to 60% of the total sales should come from the regulated markets.
By when, Saloni?
Saloni, by when do we see this 55% number?
So we anticipate, because a lot of the current product portfolio that we have, other than the key products, we have already applied for a lot of registrations in the European market, in the US market, in the Japanese market. So most of these registrations will start coming through maybe Q3 of this financial year. So FY25 would be the right time for you to see an increased traction of some of the other products from the portfolio in the more regulated markets.
Right. Hi, Saloni. Good to speak to you after a while. Saloni, the street will be happy at least to see Q4's numbers, because after Q3, people were very, very nervous with those mid-teen margins. Safe to say that the worst of margins are behind for now. You did high 30s. So what kind of a band are we looking at? I understand somewhere around 30% is what you're guiding for. Is there a downside, upside risk from there? And also, given that last year was a degrowth year, and you did close to 530 crores in FY22 itself. So for the coming year, can we work with the vicinity of close to around 570 crores or 560, 570 crores with margins in that vicinity of around 30%?
So one of the main reasons why we had a lower revenue last year, we have also explained this in the past, is one of our key therapies, antihistamines, and one of our key markets, China, got badly impacted. And because of that, we had the lower revenues and, of course, the hit on the margin. Having said that, we have been aggressively working on de-risking our portfolio. We are trying to register more of our current products in more regulated markets. The CEPs and everything is coming through. And that is very much visible in Q4, where we saw an increased traction for some of the other therapies like anesthetics, anti-allergics, vitamins, anti-asthmatics. These have performed really well in the regulated market space. And that's why the margins have sort of stabilized again. However, going forward, because this is driven by a certain product mix in the more regulated market space, going forward, we still maintain that the achievable, sustainable margin for us would be around 28 to 30%. That's because we keep on infusing new products into the portfolio for further de-risking of the portfolio. Yes, we did have a lower base this year. Historically, we have grown at about 20% year on year. But because the base is slightly lower, we anticipate that this year, the growth would be slightly upwards of that 20%, 22 to 24%, slightly higher than that is what we are imagining for this year.
So around 560, 570 crores, 570 crores odd. I think that will be a fair estimate?
That should be a fair estimate, yeah.
All right. And what about
on a
capacity?
More conservative side, that is.
All right, that's more conservative. So you'll probably outdo the 570 crores that you're talking about. 22 to 24% should be, the percentage growth. All right, take that point. Just wanted to understand, you have increased your capacity and you have plans to increase your capacity as well. I was looking at your presentation. The capacity increases from closer to 600 KL to about 900 KL by the third quarter. How much of that would be towards backward integration and how much of that would be revenue accretive? Just wanted to understand, what is your backward integration proportion right now? And at full capacity, what's the kind of revenue you guys can do?
So in terms of backward integration, the top 13 products which contribute to almost 70% of my revenue currently, they are fully backward integrated. The capacity what we are adding now, most of it actually would be for the incremental sales that we are envisaging from the current basket of products once they move into the more regulated market space. So I would say about 80-90% of this capacity would be for the volume scale up coming from these products. We are also actively discussing a lot of CMO opportunities. One we have recently announced. So a lot of volume scale up will happen on those CMO opportunities as well. So most of this capacity would be dedicated for volume scale up and revenue generation.
And will the revenue grow in line with the capacity? Because your capacity is increasing by 50%. So should we assume that your revenues also increase by 50% over a period of time once they stabilize in utilization?
Yes, definitely. See, what happens is because we operate in the more regulated market space, it takes a little while for some of these products also to do the registration. The timeline is anywhere between 12 to 24 months. So although the new block, the module E, would come up in Q3 of this financial year, but for the entire activity to happen in that block, the validation to happen, the products to scale up in regulated markets definitely would take up another financial year. So let's say around FY25 is when we anticipate that this block would be more than 50% utilized.
All right. Saloni, if we look at your business, you're guiding in terms of getting capacities coming on stream. CMO project as well, you've got from a European player that was close to around 400 crores, which is around 40 crores per year. Give and take everything, you think by FY26, could you be a 1,000 crore revenue company? And if yes, what about the CMO business? I think in the past you were telling us maybe 20% of revenues will come in from CMO. Stick to that?
Yes, by FY26-27, the financial year FY26-27 is when we anticipate a good revenue generation from the CMO CDMO business. Like we recently announced a very large contract with one of the leading European companies where we are the sole supplier. And once you get an entry into the global platform, a lot of more opportunities open up for you. Having said that, our existing product portfolio itself does have a lot of volume scale-up potential in regulated market space. Historically, we have grown at about 20% year on year. So we are committed to, achieving that number very soon, hopefully in FY26-27.
All right. So FY26-27, from your current business, you could do, say, around 1,000 crores. Is that doable? And also added to that, you'll have another, close to around 150, 200 crores from CMO. Fair estimate?
So while I can't comment specifically on this estimate, but definitely, you can add up that 20-25% growth from here on. And the CMO would also scale up from 26-27. So definitely, there is a lot of potential for us to reach that place sooner than later.
Right. And finally, if you could just comment on a couple of points before we let you go, Saloni. The first one is your R&D spends. How much will they be as a percentage of your sales going forward, given you have a fair amount of capex lined up for R&D as well? And secondly, you have said in your presentation that you plan to reduce customer concentration. Over the last many years, it's been between 45 to 47% in terms of revenue coming in from your top 10 customers. So how do you do that and by when do you do that?
So in terms of customer concentration, a lot of efforts have been put in fact, de-risking the product portfolio itself. The customer concentration is because of the product mix that we currently have and the geographic mix that we have. But we are adding a lot of new therapies into the basket like decongestants. We are adding anti-anxiety, anti-diabetic kind of molecules. So by the way of adding of these molecules and de-risking the current portfolio, we are very confident that the customer concentration also over the few years would decrease. Plus some of these CMO opportunities would also start kicking in. So definitely a lot of work is going on in the background for de-risking the overall portfolio and dependence of any one particular geography or customer for the company. And in terms of the R&D spend, up until last year, it was closer to around 1% of our total revenue. Right now, we've just set up our new R&D lab. It's already in operation with 20 fume hoods. The R&D is focused more on life cycle management as well as infusing new products into the basket. Going forward, definitely, we anticipate it to be closer to around 2% of the total revenue. But that would happen gradually as we keep on infusing new products into the basket.
Okay, all right. Saloni, thanks so much for stopping by. We rarely get to have a conversation with you, but thanks so much for stopping by. We're going to hold you to these numbers, and hopefully from a stock market perspective, they don't want to see margins that they saw in Q3. Hopefully things improve from here.
The worst is definitely behind us, and it's only going to be positive and better going forward.
On that optimistic note, we'll wrap up on this conversation. Thanks so much for joining in. We'll slip into a short break, though.